And it's interesting what was pointed out about zero DTE options. I've been paying attention to them ad nauseum. I was involved with Eurex when they launched them and monitored them and wrote up how the Eurostoxx 50 short-dated options were behaving relative to their U.S. counterparts. One of the things that I had picked up on, and I'm a big fan of using the one-day at-the-money straddle as a market predictor of volatility for over the short term. And I had noticed that when we have a big European component, and I really picked up on it when ASML reported back in July, the one-day at-the-money straddle on the Eurostoxx 50 was a little bit elevated pricing-wise to where it is normally. I feel like it was around $40, and normally it should have been about $32 or $33 that one day. The ASML, their at-the-money straddle was priced at 39, and it went out at around 80. They had a big outlier move the last time around. The Eurostoxx, they predicted it quite well. One of the things that, and I'm going to deviate for just a second because I know there's a question on this about the short-dated index options in Europe versus the U.S. I have noticed, because there's a lot of systematic selling of especially SPX, that because there's this systematic selling of SPX, it's very difficult to make money taking advantage of that risk premium that we like to talk about. That's not true over in Europe. There's not as much systematic selling within that market. And I feel like those options behave more like you would expect than their U.S. counterparts. And I don't know if that's, again, because there aren't ETFs that are out there selling them every day, or what the reason is behind them. But if you really want to spend a weekend going down a rabbit hole, take a look at consistently being long U.S. volatility with short-dated options and short European volatility with short-dated options. I do think that there's a lot that could be done there.